For decades, foreign capital was kept strictly outside Ethiopia's most valuable sectors. The fortress of East Africa was heavily state-controlled, self-reliant, and intentionally walled off. But now the gates are opening, and global investors are rushing in. In the latest fiscal year, Ethiopia attracted $4.32 billion in foreign direct investment, but the number itself is not the most important part of this story. The real story is where that money is going. Ethiopia is not simply opening its economy to satisfy international lenders. It is attempting something far more ambitious, converting internal liberalization into regional economic dominance. To understand why global capital is treating this transition differently, look past the single-year headlines. Many emerging markets experience sudden, volatile spikes in foreign investment, usually a single massive oil, gas, or mining concession that disappears the following year. Ethiopia's trajectory is defined by a different metric: structural consistency. This sustained inflow is anchored by a fundamental reality that long-term planners value above all else: unignorable scale. With a population base of roughly 135 million people, the sheer demographic footprint makes it the inevitable domestic market play in East Africa. But scale alone is useless if the state keeps the doors locked. The Ethiopian government is not opening random sectors to the highest bidder. It is executing a calculated, phased dismantling of the barriers that prevent foreign capital from circulating through its territory. Think of it as opening 3 strategic gates. The first gate is communication. By breaking a 120-year state monopoly on telecommunications and bringing in private international operators, Ethiopia rapidly updated its digital infrastructure, creating the foundational highway required for modern enterprise. The second gate is capital. For the first time, a historically closed domestic banking and financial services sector is allowing foreign banking entities to establish operations. This allows international financing to flow directly into the economy without navigating state-run bottlenecks. The third gate is commerce. By liberalizing retail trade and logistics networks, the state is handing the keys of transport and supply chain management over to global efficiency models. By unlocking communication, capital, and commerce, the state isn't just welcoming investors, it is weaponizing market access to modernize its entire economic skeleton. The immediate proving ground for this strategy lies within the country's special economic zones. These enclaves are designed to operate as frictionless microeconomies, insulated from domestic bureaucratic drag and explicitly built to capture the newly unlocked foreign capital. An 80% surge in goods exported from these zones demonstrates that the strategy is working on a mechanical level. Ethiopia is actively translating foreign investment directly into industrial productivity. But this brings us to a critical inflection point, because there is a profound problem with the headline FDI story. Foreign capital is not the same thing as total economic transformation. Capital inflows can create a mirage of prosperity while underlying structural vulnerabilities remain unaddressed. Ethiopia still faces intense localized currency pressure, chronic foreign exchange shortages, and a brutal question: can the country convert these investment inflows into actual hard currency exports fast enough? This structural bottleneck is precisely why that $225 million SE's export figure matters far more than the headline $4 billion FDI number. If the inflows merely stimulate domestic consumption without generating massive hard currency earning exports, the entire model risks stalling under its own weight. This race against time is why the recent breakthrough with international Eurobond holders is so critical. By successfully restructuring its legacy $1 billion Eurobond portfolio, the Ministry of Finance has signaled to international sovereign markets that it can manage its structural liabilities. Paired with an IMF projected economic growth rate hovering at an aggressive 9.2%, Ethiopia is making a massive macroeconomic bet. It is leveraging high short-term growth and debt restructuring to buy the time necessary for its new industrial base to permanently fix its balance of payments. The question is no longer whether Ethiopia is opening its economy. That process has already begun. The real question is whether Ethiopia can turn foreign capital into industrial capacity into exports, and exports into regional leverage. Because if it succeeds, Ethiopia will not simply become a larger economy. It could become the absolute economic anchor of an entirely new East African trade system.